Hello and welcome to the Providence Investment Update for October 2025. My name is Mike Alog. I'm joined here today by Mark Waite, CIO of Providence Investment Management. Welcome, Mark.
Thanks, Mike.
Mark, I just want to start with the title of the latest Global Outlook. It is selectively bullish. Now, surely you're either bullish or you're bearish. How can you be selectively bullish?
Selectively bullish because we think there's a broad range of opportunities in markets at the moment, and you need to be quite targeted about the way in which you invest. And so the real sort of overriding narrative that we'll talk about in the talk today is that it's actually quite a good time to diversify portfolios, and actually doesn't cost you very much. So if you look outside some of the highly priced markets like the Indian equity market, the US large cap equity market, technology, and the Australian market, there's actually some attractive opportunities globally within equity markets.
So, Mark, can you share the foundations of this positive risk position, if you like?
Yeah. So we led our sort of previous quarter's global outlook and strategy, and we called that Solid Foundations. And that was really a reflection about how well the underlying aspects of the economy are going, despite the large shock that we had from the trade tensions and the large increase in tariffs. And when we talk about the solid foundations, we point to some important factors there. One is the fact that you've got support from fiscal authority. The second thing is that you've found that central banks have started to move from quite a tight policy stance into more of a moderate policy stance, and they've been happy to ease policy. And so over the quarter, we've seen easing from the Reserve Bank of Australia, we've seen the Fed ease, and we've seen a number of other central banks ease, which is support markets. The other thing I think is important is unemployment rates are relatively low globally, so there's plenty of income coming in to parts of the economy. Wealth is quite high. And then the other point that's quite important is that if you look at the sort of energy price complex, I mean, that's actually been quite weak this year. So there's been less of that sort of friction. So there's been a lot of things that have really supported economies, and that's really manifested itself in quite strong earnings growth around the world for companies.
So on the other side, can you talk about any of the frictions or any of the worries that you're seeing in the market at the moment?
Yeah, and I think there are some frictions in the market that we need to look at. And we led with that note that valuations are quite high for some of the equity markets. So that's an important thing that we'll talk about later. I think the other thing is just the degree to which trust has been damaged with institutions. And so if you look to the US, we recently had quite a large march, the No Kings March, which is really sort of pushing back against the US administration. In other economies, you've seen quite large frictions. So if you look in France, they've actually had numerous governments fall during 2025, and most recently they had the second prime minister fall, and he's just come back to try and form another government. You've seen essentially rating agencies downgrade France. So if you look back to 2010, France was a AAA rated country, and now it's actually on S&P's measure, it's now moved down to single A+. So quite a big move down there. And that's really come around some of those underlying tensions around the wealth divide and the inability of the French government to cut spending within markets. And then the third thing that we think is quite important and really sort of came to the fore during the quarter was the pressure on central banks. And I think you're really sort of seeing a watering down of that independence of central banks. So despite the fact in an economy like the US that you've had these solid foundations, you've actually seen the administration put pressure on the central banks to ease. And that once again comes back to the wealth divide. So if you think about people that have got high amounts of borrowing within the economy, they'd like to see interest rates come down, and that would really allow the US housing market start to sort of fire on all cylinders, whereas it's been quite sluggish.
Well, just going back to high valuations, AI has obviously been sort of driving markets, and their valuations are reasonably high. There is some question marks around the high investment spend as well, the capital spend in AI. Yep. What's your thoughts on that?
Yeah, so we'll show a chart now, and you can see that the current investment boom around AI and software is very much in line with the investment booms that we saw around the housing market in the US in the run up to 2008, and also some of the degrees of investment during the dot-com boom. So around about 5 percentage points of GDP. And I think what's really interesting around it, particularly when you put it in a company valuation perspective, is you look at these companies that have had incredibly profitable businesses throwing off a lot of cash, and now they're aggressively reinvesting that cash, almost as though it's a sort of a stay in business investment spend. And it's not actually clear what the return on investment will be on those large amounts of money that have been spent. There's no doubt that AI will be quite transformative for workplaces and for the economy. But the question that's really been mounted during the quarter is, what's the return on that investment going to be? And you've seen some switching in markets. So you've essentially seen some of the people supporting that investment boom where their stock prices have started to move higher. So companies like hardware companies, software companies, and then some question marks around the companies, the hyperscalers that are spending a lot of money in that space.
So, Mark, given that's a large part of the market, I mean, how are we positioned from a portfolio perspective, asset allocation perspective?
Selectively bullish. So, so I think what's really important is if you look at our portfolio, we think the cost of diversifying is really low at the moment. And in fact, in some places, you're actually being paid for it. So what we've been doing is we've been continuing to sort of reposition our equity exposure over the quarter. And so we've moved to reduce some of our exposure to the US. So we've still got a meaningful exposure there, but we're actually quite underweight if you compare it to a global equity index. And we've done that because we look at the valuations in emerging market equities around about a 30% discount to US or the MSCI World. So quite attractive in terms of a discount there, quite strong earnings. And so PEG ratio is closer to 1, whereas the MSCI World has a PEG ratio above 2. So that's pretty attractive. The other place that we'd like to invest is in global mid-caps that we've talked about for a while, and we think the valuations there are still pretty attractive. They traded around about a 20% discount to the MSCI World. And then finally, we continue to be pretty bullish on Japan. So we think not only are valuations reasonable, but we also think that sort of move for corporate change is attractive, very sort of supportive policy from the central bank in that space. And there continues to be quite a good runway when we speak to our activist manager in that space. And so outside of equities, I think there's some other things to talk about in terms of how we've been positioning. So we've continued to allocate money into infrastructure space and property space. So we've sort of domestically, we've seen the bottom of the property cycle, arguably, and some interesting opportunities coming along across retail, some very selective opportunities in very targeted investments in the office space. And then we think infrastructure is a really interesting asset class. We led talking about how governments in some countries are quite constrained in terms of their budget position. And we think the opportunity in the private infrastructure space is going to be really interesting, as well as in the public infrastructure space. And then finally, we'd be remiss not to talk about the role of gold in portfolios. So that's obviously had a phenomenal run. We've got it in the portfolio as a diversifier, as something that's a defensive asset, but that's appreciated around about 60% year on year. And so there's been a real sort of run towards increasing gold as a share of global reserves, which bottomed out probably around about 10 years ago. And it's got some way to run in terms of that reserve rebuilding. And then there's also increased demand from other investors who have sort of followed our lead from 6 years ago.
And Mark, just turning to credit, there's a lot of noise in credit. Every day I read in the paper about some credit defaults and what have you. What's your view in credit and what's your exposure in the portfolio?
Yeah. And so I think it's important. There's always going to be noise around credit. There's always going to be bad loans that are made. And I think in the Australian market, you'd seen a lot of noise in the commercial real estate space around construction loans as we had that downturn in the real estate market. More recently, what's come to the fore has been in the asset-backed finance space. So in the US, you've had a couple of lenders who've had asset-backed deals within the automobile sector. So one was a parts supplier with secured assets, and actually looks as though it was fraud. So it looks as though assets were pledged multiple times. The second thing, you've had another lender in the auto space who was lending to undocumented immigrants in the US. And obviously the Trump administration has pushed quite hard to reduce the number of people in that space and actually send quite a lot of people home. So that's always pretty problematic if you don't actually have someone who's earning an income can pay for those particular loans. And then the third one was some of the regional banks got hit recently around what looks to be some sort of fraudulent activity on sort of buying up distressed offices and borrowing money to do that. So I think that the sort of key takeaway for us, and this is something we've been talking about for many years, within the private credit space, it's really important to find managers who've got long tenure, a track record of moving through multiple cycles, and extreme diligence in terms of how they underwrite the credits that they're investing in. So we still think credit's an attractive asset class. Yes, spreads are tight, but the actual all-in return remains good. We're on a sort of high alert around that space, but we continue to think it can play a role in a measured way in the portfolio with the right manager.
And Mark, switching from credit to government bonds, I mean, government bonds is an asset class which doesn't seem to get much attention. It's performed pretty well this year. It's beaten cash. Can you just explain the role of government bonds in the portfolio and why it's still an attractive asset class?
Yeah. So we've got a modest exposure in terms of government bonds within our portfolios, and we really see it as ballast within portfolios. So if you think about the environment that we've gone through, we've gone from a zero interest rate environment where government bonds were trading at negative real yields and had a pretty torrid time in 2022. And that memory is very much in the front of some people's minds. But where we are now is if you actually look at real yields, historically, real yields are pretty attractive. They're probably at the most attractive level they've been in around about 15 years. And so we do think that over time they can play a good role because of the diversification, because of the lack of correlation with equities over time, to play quite a good role in terms of ballast in the portfolios. And indeed, as you've seen some slowing in the US economy, as you've seen rate cuts come through, we've seen a reasonably attractive rally in terms of yields falling and prices of government bonds going up.
That's good. So it still has a place in the portfolio.
Very much so. Very much so.
Mark, just to round it out, is there any update from Providence you'd like to share with us?
So it's quite an exciting time for Providence. We're celebrating our 25th anniversary. And so I think from our perspective, we continue to be very true to label. So first and foremost, we're very focused on serving clients with strong risk-adjusted returns, bespoke advisory services, and really being close to serving the clients, both for the current generation and for the next generation. So we really take a lot of gratitude for the faith that clients place in us in terms of running their money for them. And we look forward to another 25 years of doing that.
Fantastic. What a milestone. And look, thank you for your time.
Thanks, Mike.
And thank you for joining us. I hope you enjoyed the conversation. If you do have any questions, please don't hesitate to reach out to any of the people at Providence. We'll be happy to help. Until next quarter, we'll see you then. Thank you.